So time value of money, they can give you questions on normal compounding. They can give you question on effective interest rates. They can give you question on sinking fund or loan amortization, which is basically going to be following the annuity principle. So you really have to understand the question very well. Right now, questions on time value of money, they are now somehow okay. Those days, you really need a deep understanding of the questions to be able to answer them. So do I have Auntie Patricia there?
Yes, please, I'm here.
Okay. After the exam, I will reward you for always being there. Okay. So take the question number 1 for us so that we can see how we can go.
Question 1. Veronica is planning her daughter's 6-year medical school education, which begins 10 years from now. Teresa estimates the yearly tuition, textbook, and living allowance to be 15,000 Ghana cedis, to be withdrawn at the end of every semester or the year. She is a board member of Ntompo Rural Bank and intends to borrow the money from the bank at a concessionary rate of 9% so that she can invest it in account that pays annual interest of 18%, from which she will finance the daughter's education. Required. A. How much must she borrow from the rural bank for the intended investment? B. Set out an amortization table for the repayment of the loan if she intends to take it for 5 years.
Okay. Okay. So they are saying that Veronica is planning her daughter's 6-year medical school education, which begins 10 years from now. Okay. She can decide to be investing 10 years from now so that the child will be able to be taking the money, maybe 15,000 at the end of the year. But the question is not telling us that how much must she invest now. If they are asking you how much must she invest now, it means that how much will she be investing now from this one. So the period will now be 16 years, but they are not saying that. So we actually pay attention to the 6 years. Okay. So the Teresa estimate that the yearly tuition, textbooks, and living allowance to be 15,000 to be withdrawn at the beginning of every semester or the year. She's a board member of the Nkotompum Rural Banks and intends to borrow the money from the bank at a concessionary interest of 9% so that she can invest it in an account that pays annual interest of 18%, from which she will finance the daughter's education. How much must she borrow from the bank for the intended investments? How much must she borrow from the bank for the intended investment? Set out an amortization table for the repayment of the loan if she intends to take it for 5 years. This is a very simple question. Okay. The amount that we are going to be borrowing, what will happen? We put it in a bank that will pay us an interest of 18%. So that should be, we will borrow the money, we put it in the bank, that will pay an interest of 18% every year, so that your child can be able to withdraw 15,000 at the end of every year. So the amount that she will be withdrawing, it is a annual cash flow, annual constant cash flow. That makes it annuity. Okay, so she has to be withdrawing. She has to be. So let's come to question number 1. Okay, so let's come to the annual annual withdrawals will be 15,000. Okay. This will be done for how many, the number of years? She withdraw this for,
6.
okay, 6 years. Okay. And the annual withdrawal is now making it what? Annuity, isn't it? Okay. And the mode of the withdrawal or the pattern that is going to be at the beginning of every year. Okay. Pattern or the mode of the withdrawal or the frequency will be at the beginning. So pattern of the withdrawal is going to be at the beginning at the beginning of every year. Okay, so this is the yearly withdrawal. Is making it annuity, which is going to be a fixed amount for 6 years, and this will be done for number of 6 years, and we are looking for it will be done for 6 years, and the withdrawal will be done at the beginning of every year. Okay, the question is, how do we finance this? We are going to be borrowing money and put the money into a bank. Okay, we are going to be investing the money into the bank, and the bank will be giving us 18% every year. So the question now is, how much you put in a bank today so that at the end of every year, you'll be receiving 15,000 as what? As cash flow. That is how you are going to be taking it. Okay. Your daughter is going to be withdrawing. It's just like you are going to be taking the money. The bank will be paying 15,000 at the beginning of every year. You'll be giving it to your child. Okay. So the question now is, how much are you going to be putting there so that at the beginning of every year, you'll be receiving 15,000? This is actually going to be a present value. So you are receiving 15,000 at the beginning of every year. And how much you put there so that at an interest rate of 18%, you are going to be what? Receiving 15,000. The amount that you are going to be borrowing will be invested for the what? For your child's what? Education. So forget about the what? The 9%. No, the 9% is not relevant now. The 9% is the amount that you are going to be paying to what? To the bank that you are borrowing from. Okay. But the question is, how much are we going to be borrowing from the bank and put it in an investment? And this investment will be giving us 15,000 at the beginning of every year. At the beginning of every year, this is making it annuity due. And the question now is, are we looking for future value or we are looking for present value? We are looking for present value because we want to know how much we are going to be investing at the beginning of the year so that it will enable our child to be able to be taking 15,000 from the accounts every year. So what is the amount that we have to deposit today? We need to find the amount, put it in a bank. The bank will be paying interest of 18%. Then at the beginning of every year, she will go and take 15,000. The remaining amount will be there, which will earn interest of 18% for the year. Then she will go and take 15,000 at the beginning of the year, up to the end of 6 years. Because the question is not asking you how much will the person invest now. If they say now, then it will be 10 years from now because the school will start from 10 years from now. Okay, so in total, it will be 6 years. But the question is not asking you how much will the person borrow now. So we assume that she's thinking about the amount that she's going to be borrowing at the start of what? The tuition for the child. So we need to find, this is just about the present value of annuity due, and that is giving us A, 1 plus R into brackets 1 minus 1 plus R exponent negative n all divided by your R. So this is how we find this will be annuity due, but it will be a present value of annuity due. How much should we put in the bank now? That is going to be giving us interest of 18%. And at the end of every year, we will be having 15,000. So 15,000 over here is the cash flow. So we are receiving 15,000 at the beginning of every year. So how much should we put there? What is the present value of that amount? The present value is the amount that we are going to be putting there. And that is the amount that we are going to be borrowing. We borrow that amount and put it in the investment, and the investment will be giving us 15,000 at the beginning of every year. So let's come to the present value. Then we don't know the amount, but we know our rate, which is going to be 1 plus the 0.18, which is 18%. Then we have 1 minus 1 point. Okay, let's just do all of them at once. 1 plus 0.18 exponent negative 6 divided by 0.18. Okay, so speed over. Okay, so we have the present value. We don't know the amount. The amount is supposed to be 15,000. Okay, the amount is 15,000, which is the cash flow. So the present value is equal to the 15,000 1.18 multiplied by the annuity factor is what?
3.498.
Okay, 3.498. So everything will give us what?
9444.6.
944.
4.6.
I'm getting 61 61915.
1914.6.
Okay, 61914.6. So you can try that again. So this is just the amount that we are borrowing now. So this is the amount that we are going to put in the investments, and that is going to be giving us 15,000 at the beginning of every year. At the beginning of every year, that is the. So if you do the withdrawal schedule for this one, you'll be able to get 0 at the end. So if you withdraw 15,000 now, this amount will grow at 18%. Then at the beginning of the next year, you withdraw 15,000. Then this amount will grow, the balance will grow by 18% again. So you can try that. So this is the amount that we have to borrow now. Put it in the bank account at the beginning of the 6 years. You take 15,000 out of it. The remaining will be put there at 18%, and you'll be getting. So if you do it one by one up to the end of the 6 years, the balance at the end of the 6 years will actually be 0. Okay, so this is the amount that she has to borrow at the start of the tuition. Okay. Set out an amortization table for the repayment of the loan if she intends to take it for 5 years. So we know the amount that she'll be borrowing now. So we have to know the amount that we are going to be paying. So if you come to loan amortization, we only look for the amount that the person will be paying at the end of every year. So this is the amount that we are currently borrowing. So this is the amount that the person will be borrowing. Okay, so this is actually the present value of the amount that you are taking from the bank. Okay, so if you intend to take this particular amount for 5 years, how much are you going to be paying? How much are you going to be paying at the end of what? Every year. At the end of every year, how much are you going to be paying towards the what? The repayment of the loan. Okay, this is the present value of the loan. And the loan, the repayment is going to be an equal amount. At the end of every year, it is going to be an equal amount. So we use ordinary annuity for the loan amortization, for us to know the amount that we are going to be paying at the end of every year. We use the what? The ordinary annuity, because the loan is going to be done, the repayment is going to be done at the end of the period, not at the beginning. Mostly it's at the end of the period. So we use the ordinary annuity, but we use present value because you are going to be taking the loan today. So how much will you be paying at the end of every year, which if you present value it will be the 61,914.16 using the what? The borrowing rate of the bank. So we find the amount that we are going to be paying to the bank every year by doing our A multiplied by 1 minus into bracket 1 plus R exponent negative 6, all divided by the R. Okay, this is going to be done at the end of every year. So this is ordinary annuity. Okay, our present value is the amount that we have calculated as the amount that we are taking as a loan. That has been calculated already, 61,914.6. Our rate is 9%. Okay, this will be exponent n. They are asking you for 5. And our n is equal to 5 years. They are saying that if we want to take this for 5 years, what will happen? So we now have our 61,914.6 is equal to the amount that we are going to be paying every year. 1 minus into brackets 1 plus 0.09 exponent negative 5, all divided by 0.09.
The annuity is 3.890.
3.890.
890.
Okay. So let's just find the amount, which is the, so we find the 61,914, 61,914, 61,914.6 is equal to A multiplied by
890.
Okay, 890. Okay. So our A will be equal to 61,914.6 divided by 3.890. What are we getting as the amount that is going to be paid?
15,916.3.
Okay, that'll give us
15,916.
15.
916.35.
Okay, 916.35. So this is the amount that you are going to be paying every year towards the repayment of the loan. This is the amount that you are going to be paying every year. And they are asking you for the loan amortization table. The loan amortization table, we just have the loan amortization table here. Then we have the years. We have the amounts. We have the interest. You have the repayments. Then you have the balance here. Okay. Year one. What is the amount that we are currently owing the bank? It will still be the amount taken, the loan taken, 61,914.6. Okay. This will attract interest of what? 9%. So what will be the interest? What will the interest on the amount?
5572.31.
Okay. 5572.31. Okay. At the end of the year, what will happen? We are going to be paying how much? 15.
15,026.35.
Okay. So what will be the balance on the accounts of the entity? How much will the entity will be owing now? You are owing 61914 at the beginning. You are paying interest of 5,572.31. So if you're not paying anything, the amount that you are owing will be the amount that you are owing at the beginning plus the interest. But now you are paying the 15 out of it. What are you going to be having as the closing balance on that particular account? 15,916.35. I'm having 51,570.56. Okay, that will be the balance on the loan account, the amount that you are owing the bank at the end of year one. This amount will now be the opening balance for year two. That will be the amount that the bank will charge interest on. Let's multiply that by the interest rate, 9%. I'm having 46,465. Okay. And we will still pay 15,916.35. What will be the amount that we are going to be owing the bank at the end of this year?
$40,295.56.
For
40,295.56.
I'm having 43. Or someone
Senior, how are you getting your balances?
a balance is the amount plus the interest minus the repayment.
Plus the interest, okay.
$5170.56 plus 4641
295.5.
minus 15,916.35. Okay, 4295 points.
0.56.
Okay. So 4295.56. This will be the amount that you are owing this year. The amount that you are owing at the end of this year will be the amount that the bank will be charging interest on. So that sometimes the question will tell you that the interest is charged on reducing balance basis. Reducing balance basis means that you are going to be pay interest on the amounts or the balance in the account. Maybe they say it is charged on straight line method. It means that the interest will be charged on the principal. Whether you have paid some part or not, it will still be charged on the principal. And mostly it is going to be on reducing balance basis. So you pay interest on only the amounts remaining. So the interest will be 36.60. At the end of the year, we will pay 15,916.35. Okay. How much are we going to be getting?
$28,005.81.
Okay. This will become the amount that the bank will charge interest on. So what will be our interest, which is 9% on that?
2520.5.
Okay. 2520.52. Okay. At the end of the year, we pay 91. We pay the 15. So the repayment is going to be a fixed amount that you are going to be paying at the end of every year. Okay. So you have the 15. How much are you having? 14. 9.98. So year 5, that will be your amount that you charge interest on it. Okay, so we have the 14,609.98. Then you look for your interest. Then you look for your repayment. Please don't charge the interest yet. Because you have to know that at the end of the 5th year, you have to pay your final amount on the loan, and that is going to be final. So you don't have to have a balance again. So 15,916. You have to pay 15,916.35, and that will be the final year of the loan. Okay. Sometimes if you charge the interest and add it might be higher than the amount that you are going to be paying, or lower than the amount that you are going to be paying. You have to know that in the final year of the loan payments, after you have made your yearly payment, there won't be any balance on the loan again. So what you do is that, what is the balance at the beginning and what is the amount that I'm paying? I know that the balance at the beginning plus the interest will give me the amount that I'll be paying. So you can just find the difference between the two and name that one to be the interest. So find the difference between the two and put it there as the interest. Okay. So how much are you going to be getting?
$1,314.90.
Okay. 1,314.90.
No, 1,314.90.
1,314.90, isn't it? Okay.
Yes,
But if you calculate the actual interest, you see that it will be 13 something. It will not be 14. It will be more than that. If you add, it will be higher than this, and you'll be having balance on the account. No. In the final payment, there should not be any balance on the account. So what you do is that look at the amount at the end. Look at the amount that you are going to be paying. You know that at the end of the 5th year, if you make your loan repayments, it means that you are not going to be owing the bank any amount. Okay.
sorry.
So senior,
30.
you subtract the 15916 from 14. Now you mean subtract 14609 from 15916, right?
Yeah.
So I'm getting 1306.
1306.32.
Mention it again.
1306.32.
1306.
37.37.
I'm also getting 32.
Let me confirm that.
Please confirm. 15916.
1460.
Okay, 0.37.
0.98. I'm getting 1306.37.
Yes.
Yeah.
Yes. Yes.
Okay. Three, 7. Have the 15. Okay. All right. So this is about this one. And I was saying that if the question is asking you that how much should she invest now, if the question is adding now to it, then it means that you are going to be taking into consideration the 10 years, because she will start planning for now. So you have to look for the amount that she will be putting there for now. So you use 16 years. So you use 16 years. But now the question is just asking you how much she should borrow. Okay. You can be your child will be starting school 6 years from or 10 years from now. And you'll be thinking about, okay, the time that she will start the school, what are you going to be doing? Okay, so the plan will start from the time that she will start the school. But the question is saying that how much will she borrow from now? It means that you are thinking about now. From the 10 years from now, what are you going to be doing? Or what will you start doing from now? before she will even start the school. So you have to take into consideration the 10 years. But the question is saying that how much should she borrow? You can be planning 10 years. Okay, 10 years time, my daughter will be going to school. So if she starts the school, what am I going to be doing? How do I plan for that? So as soon as she's going to be starting, I have to put a certain amount of money in the account. That is the situation over here. But the question should have asked now. Then you have to now start planning from today, which is the now. And you'll be putting that particular amount of money. So you have to do for 16 years. So you go and borrow from now. You go and borrow from now. So how much will you borrow from now? So that at the start of 6 years, your child will be taking 15,000. So it means that after finding this is for only the first 6 years, which is 10 years from now. Okay, this will be at the start of the school. So if they're asking you from now, then it means that you have to now, this will be a future value at the end of the 10 years. This is at the end of the 10 years where she will start the school. So we are using 15,000 from the time that she will start the school. So this is the future value at the end of the 10 years. Then you now present value this amount to today's term. Then you now present value this amount to today's term using 18%. So present value in this one, we are going to be using compounding because we are not going to be putting a fixed amount over there. We just put a lump sum today so that at the end of the 10 years, that amount will give us what? 61,914.6, and our child will start taking 15,000, and that will still be any interest of 18%. But the question is not asking for now. So how much will she borrow? That is from the start of the what? Of the education of the child. And that is why we didn't take into consideration the 10 years. Okay, let's see what we can do. You really have to understand the time value of money questions. But right now they are making it to be very easy and very simple as compared to those days. Auntie Patricia, can we move on?
B. A company has a cash inflow stream from year 1 to 3, totaling 30,000 Ghana cedis. Management of the company has provided you with the below information to assist them in choosing the best cash inflow stream. Stream A, stream B, stream C, and stream D. Required. Assuming the interest rate is greater than 0, which of the following cash inflow streams would you recommend for the company and why? Please, I'm done.
You are done.
Yes, please.
Okay. So they are saying that assuming the interest rate is greater than 0, okay, which of the following cash flow streams will you recommend for the company and why? Okay. So these are the money that we want to invest. We have a cash flow in streams of year 1 to year 6, and we are having 30,000. Okay, management of the company has provided you with below information to assist them in choosing the best cash inflow streams. Okay, you can see that all of these amounts are all of these amounts. Okay, at the end of, if you are looking at the future value, you know that at the end of the day, they are all going to be giving you 30,000. Okay, but the question is, how can we be able to choose what a better stream over here? What we do is that we try to use a discount rate. Because the question is saying, assuming the interest rate is greater than 0. So you just pick interest rate, any interest rate yourself, any rate yourself. Then use the rate to what? Present value all the streams and all the cash flows under the various streams. Then you look at the one that is giving you a higher present value today. Then that is what you are going to be picking. So these are all future value. They are going to be arising at the end of every year. So let's now find the present value of all the streams. The present value of all the streams. How much are we going to be getting from all of them? So you just use any rate at all for yourself, because they say assuming the interest rate is greater than 0. So pick any rate that is greater than 0. You can pick 10%, you can pick 50, you can pick 5, you can pick 8, you can pick 9 to present value these amounts, because these are all future cash flows arising at the end of every year. So you look at the stream A, what are you going to be doing? So you come to your E part. So let's come to the stream A. Okay, the stream A. If you like, we don't have time. You don't have to do years over here. You don't have to do cash flow over here. You don't have to do discount factor. Then you do present value. No, we don't have time. So what are you going to be doing? We have another way of calculating that. So you can calculate your present value as a summation of all the cash flows there. Okay, so our present value stream A will be 2,500 using the rate of 10%. So we have 2,500 divided by 1.1 plus the year 2 is what?
7,500.
So you have your 7,500 divided by, this will be in the second year, so 1.1 exponent 2 plus 20,000 divided by 1.1 exponent 3. So what will be our present values? So you can just add them and move on. You don't have to be doing year and year. You can also find your present value like this, because we know that for us to find this is calculated as, discount factor is calculated as 1/1 plus R exponent n. Then we multiply it by the cash flow. So multiplying this will be this multiplied by this multiplied by this. So the cash flow divided by the discount factor. That is also another way of calculating that. So what are we going to be getting for the first one?
2272.73.
Okay, so we have 2272.73. Okay, the second year will give us what?
6198.35.
6198.
98.35.
Okay, the third year will give us what?
15026.30.
15026.30.
0.3.
Okay, so what will be the present value of all the cash flows?
23,497.37.
23,497.37.
Yeah.
3738.
Any of them?
Okay.
Okay, let's come
So
to,
this one will be 38, yes.
okay, let's come to,
Mariano,
yes, please.
so if you guys put everything on the calculator and give the figure, would that one also be okay? Like
Yeah.
what you, yes, that I did that and I'm getting the same figure.
Are you saying that
Okay.
they will give you 3 marks, or maybe 3 marks for only putting the figure there? Is that what you're trying to say?
Yes,
Oh, really?
I'm asking.
Oh, wow.
Not like if you put this in the PV
How-
is equal to 5 divided by 1.1 plus 75 divided by 1.1 raised power 2. After that, you just can say PV is equal to 2.
Okay.
Oh,
Okay.
yes, I'm asking. Without get all the marks.
No, I haven't marked FM before, so I have no idea. But what I will tell you that using 3 steps will be okay. The first one is okay, those ones, okay. If you like, you can omit this one. Then while you bring that, you say that PV is equal to cash flow 1/1 plus 1 plus R exponent n. Then you can say, okay, you come to the second one, cash flow 2, give us 1 plus 1 plus R n plus 1. Then you come to cash flow 3. Then you have your 1 plus R n plus 2. Okay. Then if you now bring these figures over here, 2,500 divided by 1.1 plus 7,500 divided by 1.1 exponent 2. Then we have 2,000 20,000 divided by 1.1 exponent 3 without bringing the additions. Then that one you can bring this one over here. So it means that you have shown the 3 steps already. So at least it should be maybe how you calculate how you calculate it, how you are going to be calculating, which is this one that you have stated and the figures that over there. So the next one can be answers, no problem. But if you are using these ones, then it
No.
means that you just add the figures over there so that at least you can, sometimes you can look at the marks allocated and see if you can show the but at least should be 3 or 4. Okay, depending on the question, the steps should be 3 or 4. Okay, that is it. But just writing the figure there, it's going to be there. You are not doing the time that we are at the university, we call something, is it automanto or something like that, auto filling or something like that. Okay.
Automanto.
Yeah, you feel those one that they can just ask you, you put the figure there. That one is different, but that's not this one. Okay, let's come to stream B. The stream B, we are the rate that we are going to be using will be 10% for all of them. Okay, so let's calculate
Good
that.
morning. Hello, good morning.
Is a good money
Please
coming
repeat
here?
it. Yes, I'm speaking to you.
Okay.
Yes, I wanted to ask how did you get to your 1.1?
How did I get?
The 1.1.
Okay, somebody should help. If we are all keeping quiet, then it means that we are all okay, but she's not okay. How did we get our 1.1?
The question says we should take any rates. The rate should be more than 0, basically.
Okay.
And you know, present value formula, it is 1 over 1 plus R. That is the rate, raised to the power n. So the 1.1 is the 1 plus the 10% rate, making 1.1.
Okay. Thank you.
All right. All right. I hope you're okay.
So can I use 2 or there is solely 1 because the one between the family?
Can you use, we are using 10%. If you want to use any rate, there's no problem with that.
Provided it's greater than the 0.
Yeah, the provided
Yeah.
rate is greater than 0. So I'm using 10%. You can use 20%, you can use 50%. The rate should just be greater than 0. All right.
Thank you so much.
Okay. So let's look at the second year. The stream B, we are going to be having 10,000, 10,000, 10,000. What is the best way to do this one?
Using the annuity.
Okay, so let's find the annuity factor and multiply. So we are going to be having the A into bracket 1 minus 1 plus R exponent negative n all divided by R. So you can just find your 10,000 multiplied by the annuity factor 10% for 3 years.
2.4869.
2.48.
69.
Okay,
7.
2.487, isn't it?
Yes.
Okay. So we'll be having our present value to be
24,800.
870.
Okay, 24,870. That is the present value. Let's come to the stream C. Okay, let's stream C. Let's look at, you can also find the annuity. You can also find the discount factor 1 by 1 and multiply it by the cash flows. There's no problem. So you can say your present value is equal to, then you see 20,000, then you multiply it by a discount factor. There is no problem with that. You can also do that 1 by 1. So let's have our 20,000 divided by 1.1 plus The second, okay, so let's have 20,000 divided by 1.1 plus. The second year cash flow is what?
7,500.
Okay, so we have 7,500. 7,500 divided by 1.1 exponent 2 plus 2,500 divided by 1.1 exponent 3. So what are we getting for the first year?
1818.82.
Hold on. So we have 181.82. Okay. Second year is what?
6198.35.
6198.35. Okay.
2212.40.
12.40. If you put the two together, what are we having? All the three.
The last one is not this. It's 1878.29.
29, yeah.
18.
78.29.
Yeah.
Okay. So the total will give us what?
Two six two five 8.46.
Okay. So let's come to the stream D. The stream D. What are we going to be having for the stream D? We have 2,500 for the first year. 2,500 divided by 1.1 plus 20,000. 1.1 exponent 2 plus 7,500. 1.1 exponent 3. The first year will give us what?
The first one will give us 2272.73.
270.73. Okay.
Okay. Second year is what?
16528.93.
Last year.
Five six three five 34.86.
So 5634.86. The total is what?
244.36.5.
24426.5.
36.5. Yes, 36.5.
244
244. 36.
76.
36.52.
Okay, 36.52. Okay, so which of the streams that you are going to be advising them
C.
towards? The C,
C.
isn't it? Okay, so
Yes.
that is all about this question. There is nothing extraordinary that you have to do. Okay, so that is it. Question number 2A.
Question 2. Jane Kyo has the following investment options to choose from. Post Office MIS scheme, monthly interest 8% per annum. ICD bank deposits, quarterly interest 8.25% per annum. HDFC Limited, how interest 8.5% per annum. Required. Using effective interest rate. Advise Jane to go on the preferred investment option.
Okay, so this one they have so many options. So they have so many options to choose from. Either you invest in a post office AMS scheme, which is monthly 8% per annum, and you also have the ICD, which the deposits is quarterly 8.25 per annum, and you have the HDFC Limited. Their interest rate is what 8.5, which is paid semi-annually per so 8.50 per annum, which is done semi-annually. So the question now is, if we have 50,000 that we want to put into the investment, they can also give you figure and they ask you which of the investment they should invest in. So you can find, okay, if I have 50,000 and the interest is compounding monthly, how much will I be having at the end of that particular year? So how much will I be having at the end of that particular year if you are doing it for the first one? So I will show you how we calculate the effective interest rate by using this particular situation. Assuming we have 50,000. Okay, how much are we going to be having at the end of year one if the interest is compounded monthly at 8%? Would that be the future value, which will be year one, equal to the present value? Okay, this amount you have to be compounding it at the end of every month. So what will happen is that the first month will be the 50,000 plus the interest for the first month, which will be 8/12. I hope we agree with the 8/12, which is the 8%. Okay, monthly interest rate will be 0.08 divided by
0.8, yeah.
okay, multiplied by this amount. Okay, then the second year's own will also increase by 8%. So what we do is that we consider you are multiplying. So what we do is we have the 1 plus R exponent n over here. Okay, let's come to our future value over there. The future value give us the 50,000 multiplied by the 1 plus 0.08 divided by 12. Okay, we are finding this for a year, so it will be exponent 12 because the interest is charged monthly. So if it is charged monthly, it means that we are going to be doing the compounding for 12 times. So what are we having as a total answer?
One 25908.51.
The total
125. Yes. Oh, sorry. I didn't do the over 12.
49.97.
5.
541.
Okay.
49.98.
49.98. Okay. So this is the amount. So what is the interest portion? What will be the interest that we are paying here?
4149.98.
So we can say that the interest on this amount will be 54149.98 minus what? 50,000.
50,000.
Okay. Okay. So in this case, we are looking for interest rates. We know that all of this is the amount, which is the future value. So if you take the interest from it, if you take the principal from it, the principal is the 50,000. So if you take the principal from it, the answer that you are going to be getting is the interest. So what we do is that we try to find our effective interest rate, effective interest rates. We find it by looking for, okay, if you want to find the amount at the end of the year, what will be the amount? The amount will be 1 plus the R exponent n. That will give us the amount. So if you want to find the interest portion, what do? You subtract the principal from it. And the principal was a 50,000 that we have subtracted. So this is the principal plus the interest. So you take the principal from it and you get this one. But this interest is done monthly. So our future value will be 1 plus the R over the M, which is the number of times that the compounding is done. Then we have our N multiplied by M. Then this will be minus 1. Then we multiply all the answer by 100%. So this is how the effective interest rate is actually calculated. So we have all of this, then we multiply by 100. So let's calculate the effective interest rate for the option 1. Okay, so the option 1, the effective interest rate for the option 1 will give us this one. So the effective interest rate is not actually a formula that they are picking. Okay, it's calculated based on the future value understanding, like the one we did the value minus the principal. So this will give us, let me write this one, well, 1 plus R over M exponents, the N minus multiplied by this all over 1. Minus 1 rather, not all over 1. So it's just like the same thing that we have done. Okay, let's come to the first one. We are going to be having 1 plus 0.08 divided by 12, and the compounding will be down 12 times. So this minus 1. Then we multiply by 100. What are we having? Okay.
8.3.
Okay. 8.3. Okay, the 8.3, oh, I've taken that one, the first side off. Okay, the first side off. Our interest was how much?
414 something after that.
Okay, 4149. I'm sure 4149.5.
Yeah, 4149, yeah.
0.98 or 58 or something. Okay, if the person can mention that to us. Okay, so this is the interest. This interest was earned on 50,000. So if you want to find the effective interest rate, you can also do 4149.98 divided by 50,000 multiplied by 100. I'm sure you'll be getting 8.3 something. Okay. Let's come to option 2. Okay. Option 2. What is happening with the option 2 there?
Please, where are you getting those amounts from, or is just an assumption?
Yes.
So I didn't hear you.
Yeah, I was asking where you had the four.
Assumed figures. Okay.
Come again.
They are assumed figures. There are something that I'm
Okay.
using to explain.
Okay.
So option 2, our effective interest rate will be equal to, how is the compounding done?
Totally.
Okay, so we have 1 plus, what is the yearly rate?
0.0825.
So quarterly will be divided by 4, isn't it?
Yes.
Okay, then this will be done 4 times minus 1. Then we multiply the answer by 100. What are we going to be having?
8.51.
Okay, 8.51%. Let's come to the option 3. For the option 3, our effective interest rate will be equal to 1 plus what? What is the rate there?
0.085.
Okay, divided by
2.
Okay, exponent.
2.
Okay. Multiplied by 100. What are we getting?
8.68.
8.68. Okay, so which of the options, which of the investments should they choose?
The last one.
Okay, they should pick this one because this is giving them
Option
a
3.
higher interest rate as compared to the other ones. That is just about that particular one. There is no big deal about.
B.
Yeah.
Brain Limited intends to purchase new machine costing 303,000 Ghana cedis. The funds to buy the assets are being provided as a loan by the CEO of the company at an agreed rate of interest of 12% per annum. The loan and interest will be repayable in full at the end of the fourth year. To provide for the eventual repayment, the board of directors have decided to put an equal annual amount at the end of each year into a sinking fund account to earn 14% per annum. Required. What must be the annual payment into the sinking fund so that the loan will be repaid after 4 years?
Okay. So this is about. Okay, this is about sinking fund. The sinking fund is an amount set aside for future commitments. Okay, so before you can set aside that particular amount of money, you need to know the value of your future commitments, and we have to calculate that now. Okay, if you want to set aside an amount of money towards your building project, you have to know the total amount that the project will be costing you at the time that you want to start. Okay, a company intends to purchase a new machine costing the company intends to okay. So yeah, so the machine, when are we purchasing the machine? It's now, isn't it? So the machine will be purchased now. Okay, but where are we getting the funds from? The funds will be taken from the CEO of the company at an agreed rate of interest of 12% per annum. The loan and then the interest will be repayable in full at the end of the fourth year. So the question now is, as soon as they see that the loan and then the interest will be repayable, that is compounding, because you are not going to be paying the interest as a separate amount. So the interest will be accumulated together with the loan, and you pay all of them at the end of what? Of the fourth year. So the question is, we have to know how much we are going to be paying the CEO at the end of the fourth year before we can now set aside a certain amount of money towards that particular repayment. So you have to know the amount that you are going to be paying at the end of the fourth year before you now make the provision for that particular amount. So the CEO is giving us 303,000 today at an interest rate of 12%. This amount will be paid together with the interest at the end of the fourth year. So they say the loan and then the interest will be repayable at the end of a particular period. It means that this will be a compounding. The interest together with the principal will be rolled over every year to the end of this one. But if you are paying the interest at the end of every year, it means that you are only going to be owing the person principal at the end of every year. The interest of 12% will be paid at the end of the year. So it means that you have only principal. So if the interest is paid at the end of every year, that will be the interest calculation will be a simple interest. But if the interest and then the principal will be paid at the end of a particular year, it means that the interest together with the principal will be rolling over at the end of every year, and that will be a compound interest. So in 4 years' time, at 12%, with a value of 303,000, how much are we going to be paying the CEO? We need to know the amount that will be paid to the CEO before we can know the provision that will be put aside. So we need to find the fair value. I'm with you.
He said if the interest is going to pay at the end of the 1 year, it will be simple interest, right?
Yes, please.
Okay, thank you.
All right, so let's calculate our future value. That will be the present value, which is the amount that we are taking, multiplied by 1 plus 0.12 or exponent 4. So we have 300,000. That is the amount that we are going to be owing the principal, the CEO, at the end of the 4th year. How much are you getting?
Four
476.
776.37.
Okay, 47.
476,776
Seven,
and 37%.
776.
776.
Okay. 776. 37 pesos, isn't it?
Yes.
Okay. This is the amount that you are going to be paying the principal. You are going to be paying the CEO at the end of the 4th year, together with the interest. Okay. The question now is, we want to what? We want to provide for this particular payment. So we know that at the end of the 4th year, we are going to be paying this amount. We want to be putting an amount somewhere at the end of every year that will help us to what? To pay this amount. So we now come to the sinking fund now. Okay. So the sinking fund is an amount set aside for a future what? Commitment. So our future commitment over here is the 476,776.37. And we want to put an equal amount. We want to be depositing an equal amount. Okay, an equal amount at the end of each year into a sinking fund account to earn what? 14% what? Interest. So we are going to be putting the amount there at the end of every year. So at the end of every year means that is what? Ordinary annuity. So we will have to know how much should we be putting there at the end of every year that at 14% we'll be able to accumulate what? 476,776.37. So what we do now is that we have our amount multiplied by the 1 plus r exponent n minus 1 all divided by r. That is future value. We'll be using future value. So we have the amount 1 plus r exponent n minus 1 all divided by r. What the future value over here is 476,776.37. So what is the future value for? What will be the future value? The factor, compounding factor is what? We are having 14%. Okay, so let me just put it over here.
2.921.
1 plus 0 points.
You have 4.921. The annuity factor.
Okay. So I'm coming, let me do this one well. Exponent 4 minus 1 all divided by 0.14. Okay, what are you having?
4.921.
Okay. You have your, so we have 476. Four seven
776.37.
37 is equal to 4 point what?
921.
1 A. It will multiply the A. So we divide both sides by 4.921. 4.921. What are we having as the
96. It is 6.07.
okay? So this is the amount that they have to be put in there every year towards the repayment of
So if they're asking you to construct the single fund schedule,
The sinking fund schedule.
yeah,
Yeah, you can do that. There's no problem with that. Okay. So what is actually it's already 5:30 here. Let's see if we can finish some of them and do the financial risk management. Okay, let's see. Okay. Okay,
Oh,
that will be C, isn't it?
yes.
Okay.
C. Digital Limited has some computer industrial plants which it intends to replace 4 years from today. The company's director estimates that the cost of the plant of the company at that time will be 30 million Ghana cedis. To finance the operations, the finance director has decided to set up a fund with Golden Bank Limited. Golden Bank Limited has assured the finance director that if he opts for this option, the rate of interest will be fixed at 8% per annum. The finance director intends to set aside a constant amount from his annual budget to finance the plans. The rate of interest will be compounded semi-annually. Required. The amount that the finance director should deposit with Golden Bank Limited every year to achieve his objective.
Okay. Okay, so what are they saying here? What is this question is about what?
sinking fund.
Okay. Okay. That is about that question is going to be about sinking fund. Okay. So what is the future value here?
30 million.
Okay. So we are looking for the amount that we should be putting there at the end of every year. Okay. Is it going to be at the end of every year or at the beginning?
At the end.
Okay.
No.
That has not been stated, isn't it?
I think it should be at the beginning because it says the finance director intends to set aside a constant amount from his annual budget to finance the plant. The rate will be compounded semi-annually. So the semi-annually is making me think it should be at the beginning.
No, it should be if it is silent, it should be at the end. Okay. If the question is silent, it should be at the end of the year. Okay. So the finance director intends to set us aside a constant amount from his annual budget to finance the plants. Okay. The rate of interest will be compounded annually. Okay, the finance director intends to set aside a constant amount from his annual budget. So from his annual budget, since the budget is going to be for the year, we can still put the amount there that we are going to be investing this amount at the end. That amount will still fall within the annual budget because the investment will be done at the end of the year. So it still be part of the annual budget. So if they are selling, just pick at the end of the year. So we pick that. That will be question 2C. We have our future value. This is our annuity. This is ordinary annuity. So we have the future value. 1 plus R exponent n minus 1 or divided by R. And we have 30 million over here as our future value. So we have, what is the discount? What is the rate there? Sorry, we need to modify this formula very well because that is the annual one. So we have 1 plus R over M. I hope you're okay with that.
Yeah, semi-annual, yeah.
Okay. R multiplied by M minus 1, all divided by R over M. So what you do is you don't have to stress yourself. We have the future value of 30 million. So we have 30 million is equal to A. Okay. What is the rate? What is the yearly rate?
8%.
Okay. So when are we going to be buying so that will be 4 years. Okay. So 4 years. So we have 1 plus 0.08 divided by 2. Okay. Multiplied by, so 4 years, semi-annually, how many 6 months are we going to be having in 4 years? Would that be 8?
8.
Okay. So this is supposed to be n multiplied by n. So we have 4 multiplied by 2 minus 1, all divided by 0.08.
0.08 divided by 2.
So can you do that and give us all the
9.214.
9.2?
14.
Okay. So we have our A should be 30 million divided by 9.214. How much are you getting?
3.26.
Okay. So they should be setting aside 3.26 million every year to finance the what? The purchase of the plants at the end of the 4th year. Okay. Let's take okay. So we have only the D to be on simple interest. Then we can finish all of this. Only by 6:30 we can finish all of them. Okay. Auntie Patricia, are you there?
Yes, please.
Yeah.
D. Your father is planning for your younger sister's university education to begin 10 years from now. He estimates the yearly tuition, textbooks, and living allowance to be approximately 20,000 Ghana cedis per year for a 4-year degree. Required. A. How much would he have to deposit today at an interest rate of 8% for your sister to be able to withdraw 20,000 Ghana cedis at the end of every year for 4 years? B. If your father decides to put an equal amount in a fixed deposit account at the end of every year, how much would he deposit every year at the same interest rate?
Okay. So yeah. So you can see that this question that we are solving over here is similar to the first one, isn't it? Okay.
Yes.
But this one they are talking about now, isn't it? How much would he have to deposit today? Today means what?
No.
Now. Okay. So what do you have to do? What I've said for the first one, that is what you are going to do over here. Okay. Your father is planning for your younger sister's university education to begin 10 years from now. Okay. He estimated that a yearly tuition, textbook, and living allowance to be approximately 20,000 per year for a 4-year degree. Okay. The question now is, how are we going to be deposit this amount? Are we going to be depositing this amount at the end of every year, or it will be at the beginning of every year, depending on the education? Okay, are we going to be putting the money at the beginning of every year, or we put the money there at the end of every year? If you are putting it there at the end of every year, how much would the person use to start the education? How do we pay school fees? It will be done at the beginning or
At the beginning of every year.
so if you come to school, if it's going to be about school fees, the deposit will be done at the beginning of every year. You can't allow the person to go to school and say, okay, you are coming to pay. The person will go to the bank and withdraw 20,000 at the beginning of every year. So you go and put the money there, then the person will go and take it for the first year of education. The person will wait, go to school, and the person will go and take money and come and pay at the end of the year. No, it doesn't work like that. Okay. Or they are also silent about it. If you use at the end of every year, they can have an arrangement with the school like that, and there's no problem with that. Okay. But the best assumption over here is that the deposit will be done at the beginning of, or the withdrawals will be done at the beginning of every year. So at the start of the semester, they will take the money, and that will be at the end of the year. So the best assumption over here is that it will be at the beginning of every year. Okay. And these withdrawals will be done for how many years?
4 years.
Okay. So what we have to do now is that we need to find the amount that will be in the account. The amount that will be in the account at the end of the 10th year, so that your sister can be taking the 20,000 at the end of every year. So you are going to be assuming as if your sister will be taking the 20,000 now at the end of every year now. So what will happen is that if we are putting that money over there and the person will be withdrawing, it's just like a present value. We are doing this at the beginning of every year. And what is happening is that you want to put a certain amount of money into a fund now, so that at the end of every year, at the beginning of every year, you will be taking 20,000 from that particular investment. So we have the question 2D here. Then this will be a present value of annuity due. So we have A into bracket 1 plus R. Then we have 1 minus into bracket 1 plus R exponent negative N, all divided by the R. Okay, so this will be a present value because the cash flow every year is 20,000. How much are you going to be putting into an investment that at the beginning of every year you'll be receiving 20,000? So just present value of those amount that you are going to be receiving. So we have the present value is equal to the amount which is at 20,000 every year. 20,000 every year. Then what is the investment rate?
8%.
Okay, so we have 8%. This will be done per annum, so we don't have a problem. 1 plus 0.08. Then you have 1 minus into brackets 1 plus 0.08 exponent.
Hello, Sinalano.
Yes, I can hear you.
Yeah, please, why is it annuity due when you say it at the end of every 4 years?
Right? How much would he have to deposit at an interest rate of 8% for a sister to be able to withdraw 20,000 at the end of every year? Oh, sorry. Okay. Sorry. So the question is saying that at the end of every year, the withdrawal will be done at the end of every year. So I didn't pay attention to the question itself. Okay. So the question is now telling us that it is at the end of every year. So that will be into bracket 1 minus 1 plus R exponent negative N divided by the R. So we have 20,000. Sorry about that. Okay. So I was thinking the question is silent about how the money will be withdrawn. If that is the case, then that will be at the beginning of every year. Because for school fees, you can attend the school for free for 1 year and go and pay. Okay. So we have 1 minus into brackets 1 plus 0.08 exponent negative 4. Okay. Divided by 0.08. Okay, we have our present value. What is your annuity?
3.312.
3.312. So what is our value?
$66,240.
66,
240.
240. Is it 3.342 or 3.312?
It's correct. 312.
Okay. Okay. These amounts, when are we having these amounts in the accounts? When are we doing this investment? The time that she will start the school, isn't it?
Yes.
If she wants to start the school, this is the amount that we are going to be having in the account at the time that she's going to be starting the school. But when are we going to be doing this investment? It is 10 years from now. So this is the value that we are going to be having in the account at the end of the 10th year. So that immediately from the 11th year, she will be having these amounts. Okay. So what we have to do is that we want to now put a money aside. We want to put a money aside so that at the time that she will start the school, we can have what 66,240 in the account so that she can start withdrawing. What we have calculated over here is the time that she will start the school. The 20,000, it will be withdrawn from the time that she has started the school. Okay. But we are not going to be doing this investment at the time that she will be starting the school. We want to do it now. By the time that she will start the school, what should be the value in the account before she will start withdrawing the 20,000? It should be what? 66,240. That should be the value in the account. So it means that this is a future value from 10 years now. How much are we going to put in the account so that we can have 66,240 at the end of the 10th year? So we try to find the present value of this using the compounding because this is just a lump sum. So how much are we going to be having there so that we can have this amount at the end of the 10th year because she's going to be starting the school from 10 years now. So that will be at the start of the 11th year. And the value that we are calculating over here is from the time that she'll be starting the school. From the time that she'll be starting the school. So we need to find our amount that we are putting there today, which will be, so this is a future value for the investment. So we have the future value divided by 1 plus R exponent n. So we have our present value will give us the 66,240 divided by the 1 plus 0.08 exponent 10 because this will be, this amount will be calculated, will be at the time that she will start the school. So what are we having? We're having
30,618. 681.94.
Okay, 30.
681.94.
681.
Yes.
30.
81. 30681.94.
Okay. 30681.681.94. Okay. So this is the amount that we have to put in the account today at an interest rate of 10%. So that the time that she will start the school, she can have the 66,240 and she'll be taking the 20,000 and the investment will still be what? Will still be giving interest on that. So this is what I was talking about first, that if they say you should start investing from now, if you should start investing from now, okay, you find the amount that you are going to be having in the account. If you should start the school from that time, then you present value that one back to today's term. Okay, that is about that particular one. There's no big deal. Okay. Okay, let's come here. If your father decides to put an equal amount in a fixed deposit account at the end of every year, how much will he deposit every year at the same interest rates? Okay, so how will he be? He will be deciding to put this amount. He will be deciding to put equal amounts there from now before your sister will start her education, how much will he be putting there if you want to be putting equal amount there? Okay, what you know is that the time that your sister will be starting the school, your sister will be withdrawing what? Your sister will be withdrawing 20,000. So how much should be in the account before your sister will be withdrawing the what? The 20,000. We know that amount already. Okay, the amount that should be in the account so that your sister will be withdrawing 20,000 at the end of every year. We know that particular amount already.
It's 240.
Okay, that is the amount that should be in the account at an interest rate of 8%. So that should be taking 20,000 every year, 20,000 every year, 20,000 every year. Okay, so you don't have any problem with the amount that will be in the account. So, but how much will your father be putting into that account now? So that at the end of the 10th year, your sister will be taking 20,000 every year from that account, and the money will still be what? Will still be any interest of what? 8%. Okay, so a minute. Okay, so whatever be the case, how much should be in the account at the time that your sister will be starting the school? It doesn't, whether your father is putting an equal amount at the end of every year, it doesn't change the fact that your sister is going to be taking 20,000 at the end of every year. And how much should be in the account at that time so your sister can be able to be taking the 20,000. It's supposed to be 66240. But your father is now planning, okay, how much should I be putting into the account now so that at the end of the 10th year, your sister will be having what? The 66240. Your sister will be having 66240. So what they are asking you over here is that they are asking you to find a future value of ordinary annuity. Okay, future value of ordinary annuity, because this is the amount that your sister should be. This is the amount that should be in the account at the end of the 10th year, so that your sister can be withdrawing 20,000, 20,000, 20,000. Okay, so this is a future value. How much should we be putting there at the end of every year for the 10 years, so that your sister can be able to have the 66240 that should be taking the 20,000 every year? That's what they're asking us. So we have the 1 plus r exponents n minus 1 all divided by r. And our future value over here is the value that will be in the account at the end of the 10th year.
Right now,
Yes, please.
if you also use the present value, the present value of the annuity,
The
present value,
30,681.
No, they are asking you for the amount. How much should you put there?
yes.
Okay.
So yeah, if you are using the present value of the the amount, the PMT, that's the 30681.94. Won't we get the same A?
If you want to use the 30681.94,
You use a present value of that. The present. Okay, let me try something. You continue. Let me try something.
okay. Okay, so let's have the amounts here. We have so we have 1 plus 0.08 exponent 10 minus 1, because this will be in 10 years time, 0.08. Okay, so we have 66240 is equal to this. We have 1.08 exponent 10 minus 1 all divided by 0.08. What are we getting for the future value? What are we getting if you do the future value? The 1.08 exponent 10 minus 1 all divided by 0.08. What are we having? We don't have calculator here.
Oh, you're on it. I need confirmation. I think my answer is wrong.
You get 14.487.
875. Okay.
14 points.
487.
488.
Okay. 14 point. Can we make it
The last number is
14?
5. Okay, 14.9.
487. 14.487.
487.
7.
Okay. 14.487. Okay. So let's divide 14.487. 14.487. What are we having?
Four, 5, 7, 2, 72.38.
Okay, 4572.38. So that's if your father want to be putting a fixed amount or equal amount into the fund so that your sister can be able to complete the school. Your sister needs what? 66,240 at the start of the program so that she can be taking 20,000. So your father want to plan for this particular one now. Okay, so your father want to be putting an equal amount so that at the end of the 10th year, your sister can have 66,240 in the account and she'll start withdrawing. So how much would you be putting there? That is the 4572.38.
Now,
Yes, please.
what I was saying, you still get the same thing. No? I've done it, and you still get the same thing.
Okay, no problem with that.
Sir, please, can you go to the slide? I wanted to ask a question. Yes, sir. Sir, please, what's the difference between the 306 and 30,681 solution and then this one? What's the difference?
The
I
difference,
understand that 36. Okay.
the difference is that the first one, we are putting just an amount there. Okay, that is, you just go to the bank and put an amount there. There will not be any additional deposit again. That is the first one. It's just a lump sum. You are putting the amount there. So you just put an amount there. The amount will go at 8% every year, and that is it. But if you come to the second one, at the end of every year, we are putting 4,572 into the account.
Okay.
That's the difference.
Milano, you can differentiate by using the question 2DA and 2DB so that when you are looking at the worksheet, you can know the difference.
Okay. So this is question B, E, and this is D.
BB.
Okay. This is question 3, DB. Okay. So that is it. Okay. So please, let's take some questions on the financial risk management. Then at least we can do something there. Auntie Patricia, are you there?
Yes, please.
Sir, please, in the evening, will we have meeting?
No.
Question 3.
Yeah.
High Speed Electronics Limited has taken delivery of 50,000 electronic devices from an American company. The seller is in a strong bargaining position and has priced the devices in American dollars at $12 each. High Speed Electronics Limited has been granted 3 months credit. Assume that interest rates in America are 3% per quarter. High Speed Electronics Limited has all its money held up in its operations, but it could borrow in United States dollars at an interest rate of 3%. The borrowing rate of dollars in Ghana cedi per quarter if necessary. The following foreign exchange rates are applicable. US dollar to Ghana cedi. Spot rate $12. 3 months forward rate 14.3. No. Spot rate 12 Ghana cedis. 3 months forward rate 14.3 Ghana cedis. A 3-month dollar call option for US dollar 600,000 is available at a premium of 15,000 US dollars. Required. Determine the amount payable by High Speed Electronics Limited using the following hedging strategies: forward contract, leading, money market hedge. Use of options. B. Distinguish in a currency swap.
Okay. So this is the question. It's not anything. And it's about the currency risk management. And we have a company that is located in Ghana, and they are taking they are buying, or they have a supply from US. So what they are doing is that the US or the supply is trying to hedge the currency by invoicing in their home currency. So you can see that they are charging the company in Ghana in USD. So that is the supplier is invoicing in their home currency so that they can prevent the risks associated with this particular transaction. Okay, so the devices, how many devices are being taken? Let's find the amounts that the company is owing. So the amount owings is going to be 50,000 multiplied by 12. Is that correct?
Yeah.
Okay, how much are we having?
It's 600.
600,000.
Okay, so that will give us 600,000 USD. Okay, so we are going to be paying 600,000 USD. Okay, so they are saying that if we are using a forward contract, how much is the bank giving to us in 3 months' time?
14.3.
Okay. So using the forward contracts, the amount to be paid. The forward contract is just an agreement between the customer and the bank that they are going to be agreeing on what? On a rate for a specific transaction or for a specific amount at a specific date. I'm telling you that I'm going to be paying a supply in 3 months' time. So I don't know how the exchange rate will be moving. So give me a rate that if I come in a 3-month time, you sell to me at this particular rate. That is what we call a forward contract. So the amount under the forward contract will be 50. The 50. Okay, this is a USD.
I
Sorry.
think we have already calculated 600,000.
So the USD will be 600,000 multiplied by what? Since it's a Ghana cedi,
14.3.
so we multiply by 14.30. So what are we going to be having?
You have 8,580,000.
Okay, 8 million. So our Ghana equivalent to be 8,580,000.
Ghana cedis.
Okay, so 8,580,000 Ghana cedis. That is a forward contract. So the forward contract, you just look for the seed, the amount that you are owing. If you want to change it to CDs, how much are you going to be paying? What is the CD equivalent of that particular amount? Okay, and the forward rate has been given to us as 14.30. Okay, let's come to the next one. They say we should use what? Leading. If we are using leading,
You're
if
going to use 7,200,000.
leading means that we are going to be paying at the date of the transaction. We want to avoid the exchange rate, so we are going to be paying at the date of the transaction. That is the leading. So the leading, we are going to be paying at the date of the transaction, and that will be 600,000 USD multiplied by 12. Is that correct?
Yes.
Okay. So the leading means we are going to be paying. We are not going to be delaying this one. We are going to be paying at the date of the transaction. Although you are giving us 2 months credit, but we don't want to suffer any exchange rate issue. So we will pay on that particular date. That is the leading 7,200,000. Okay. So
Money market hedge.
let's go to the next one.
Hedge.
Okay. The next one is what? If you are using
Hedge.
money market hedge. So the money market is that you go to the bank and what?
You borrow.
Okay.
You
So money market hedge. How much are we paying? How much are we paying at the end of the 3 months?
$600,000.
Okay. $600,000. This is what is going to happen. Okay. You know that you have to go to the bank and borrow a certain amount of dollar, isn't it?
Yes.
You put it on deposit for 3 months and you get what? $600,000 at the end of the 3 months so that you pay. So what we do is that, okay, you have to get an amount. Okay, the amount that you are going to be paying will be this amount. Okay, then you get your present value, which is a dollar equivalent. You invest it for 3 months, then you will now have the amount. So you go to the bank and you say, okay, I'm going to be paying 600,000 at the end of this month. So what I'll do is that, okay, give me a dollar equivalent of that particular amount so that if I put it on an investment for 3 months, which will give me 3%, I can be able to what? I can be able to be getting my $600. So we go there, they will borrow you a dollar equivalent. They will give you a dollar equivalent in cedis. They will give you that dollar equivalent of the amount that you are going to be paying. So that will be the 600,000. You are going to invest it for 3 months, which will be 3%. And if you add the interest to the amount that has been given to you in dollar, you'll be getting the 600,000 that you pay. But this amount will be given to you, or you are going to be paying in what? In cedis. So let's look at that particular amount. What we do is that the amount that you are going to be investing will always be the present value. So we have the E, which is the future value. So you always have the future value, which is the future value divided by the 1 plus exponent n. So we have our present value to be equal to the $600,000 that we are going to be paying, okay, divided by the 1 plus 0.
1 plus 0.02 divided by 4.
No, read the question very well. Okay. Let's see 3% per what?
Per quarter, if necessary.
Okay. So the 3% is also only per quarter. The 3% is a quarterly rate. Okay. The 3% is a quarterly rate. Okay. So the company has all United States dollar at an interest rate of this, the borrowing rate of the USD in Ghana cedi per quarter if what necessary. Okay. So let's come to the, okay. So what are we going to be having here? What will be our present value?
582,000.
Okay.
524.27.
Okay. This will be the dollar that we are going to be what? We are going to be borrowing and put it on the investment for 3 months. So this, we are going to be borrowing this now. and make the provision for the 3 months. So what we do is that what is the CD equivalent of this? So we find the CD equivalent of this amount. This will be done now. So we have the 582524.27 multiplied by the 12 cities. What are you having?
6,990,291 pesos.
No, senior. I'm not working as a
Okay,
cashier. 699
0291
0291
.24.
0.24. Okay, this is the CD equivalent now, but this amount will be, you are going to be paying interest of you pay interest of 3%. Since they're supposed to give you the investing rate for the dollar, they're supposed to give you the borrowing rate for the Ghana cedis, but over here they are all 3%. So the interest rate is 3%. And you also, the United States dollar at the rate of 3%, the borrowing rate of USD in Ghana cedis. So if you want to borrow the USD in Ghana cedis, it's still the 3%. So the borrowing rate in Ghana is still 3%. So this amount will still be, so this is the amount that they will be giving to you now. This will increase by 3% at the end of the year. So at the end of the period, which is the 3 months. So you just find
Yes,
the future value of this. That will give you 699. Okay, this will increase by the interest. So by doing that, you can just find the future value of this or find the interest and add it. There's no problem with the two. So any of them that you like, you can do it. Okay, 0.24. So you can just do 1.03. Okay, how much are we getting?
71. The 995.
9999. Okay.
So you can do it 719,998. So just do 72,000 because it's 0.9. The last one is 0.9.
Okay, so let's make it 72. 7,200,000.
Yes.
Okay. So that is about the money market. So the money market, we use borrowing and investing to do that. It's not anything. You just have to understand. If you are going to be paying, you go to the bank and the bank will give you a dollar equivalent. Yes, yeah. Yeah.
We can put a point. So you bring the 999.98.
Or let's maintain the 7 2. No problem. Yes, please.
I'm still not okay without using. If they didn't need the quota, they wouldn't have. So I'm
Is that?
still not okay. The quota, the 3% quota, the borrowing rate of that is set for quota is necessary. Why did you ignore the quota?
If he said okay, 3% per what? Are you talking about the 3%? Why we didn't divide by 4?
Yes.
The 3% is already a quarterly rate. 3% per quarter. Assume that the interest rate in America are 3% per quarter. So every quarter is 3%. Every quarter is 3%. So the 3% is already a quarterly rate, not an annual rate. Are you okay? Are we okay? Yeah, if they say 2 Ghana cedis per hour, what does it mean? It's every hour is 2 cedis, isn't it? Yeah. That is it. So every quarter is 3%. So the 3% is already a quarterly rate. So we don't have to do anything about that by dividing or you doing anything, because that's already the quarterly rate. Okay.
So the year will be 12%.
Okay. So the year will be 12%. Yeah. Okay. Okay. So that is it. Use of options. Okay. What is going to happen is that most of the time they will give you the option. They will give you the option rate that, okay, you have the option to exercise at this rate. Okay. But if you are not given the option, you use the spot rate as the exercise rate. Okay. So what is going to be happening is that, okay, the spot rate is now 12 and the 3-month rate is 14.30. But we are giving you a 3-month dollar call option for $600,000 is available at a premium of $15,000. So the question now is, what we are doing is that, okay, since the bank will always give you the option rate. Okay, the exchange rate, they will give it to you that, okay, you have the option to exercise at this rate, or you wait till the actual exchange rate at that date. But this one, we are not giving the option rate. So this one will happen at, you either use the rate at that time, or you can call for, okay, let me use the spot rate instead of the rate that is going to be at the end of the 3 months. But if you want to use the spot rate, or you want to use the rate at the end of the 3 months, you will still pay the premium of the $15. So what we do is that if you come to the option, since the option rates are not given to you, you pick the spot rate as the option. So today's rate is what? Is 12 cedis. Okay, so you can decide to use the 12 cedis in 3 months' time. But what will happen now is that you are going to be paying a premium of what? Of the $15,000. Okay, so let's come to the option. The option, what will happen is that we have find the total USD, total amount in USD. If you want to use the option, that will give us the 600,000 USD plus the premium that we are going to be paying. The option, whether you are going to be exercising or not, you still pay the premium. So this will give us 615,000 what? USD. Okay. So this will give us 615,000 USD. So you use the amount that you are going to be paying. You now use the 615,000 USD multiplied by the spot rate of 12. What are we having?
7,380,000.
Okay. 7,380,000. Okay. 7,380,000. Okay. So which of the options do you think they have to use?
Leading.
Okay. You can see that the leading and the money market, they are giving the same figure. So your leading is 720. Money market is also 720. So if we approximate this one correctly, it will be 719 something, isn't it?
Yes, so the money market would have been this month.
The money market would have been the minimum. This is a cost. So you pick the minimum one. Please, let's take the last one there, which is the difference between this one. So I will solve this one and give it to you. Therefore, okay. Distinguish between currency option and what? Currency swap. What is the difference?
I think the option you have the option to either exercise or
What are you going to be saying? Okay, go and look for it. The currency option, we have done the currency option and currency swap. We have done it so many times. and I have taken my time to explain that so many times also. Let's come here. Let me just show you something. Please, if you want to find the spot rate, question number 4. What did I say about whenever the rate is being quoted like this? You need to find the minimum and then the maximum, isn't it?
Yes.
So how do we find the spot rate here? How do we find the spot rate here? The lower value will be what? The spot rate.
The lower value will be the minus the
Okay.
0.2.
So 1.7820 minus what? 0.0002. That is the
0.02.
lowest rate. Then the highest rate will be what? 1.7820 plus what?
So that one will be 1.7822.
Okay. Okay. So you have to quote your figure. That will be 1.78 what? Your spot rate will be quoted as, if you subtract the 0.002, what I have?
1.7818.
Okay, 1.7818, isn't it?
Yes.
Okay, 18 dash what? The highest rate will be,
1.7822.
okay. Then if you count your 1 month forward rate, it will also be, the lowest rate will be the 1.7829 minus this one, and the highest rate. This is how the quotation should be done. Okay, so if you are giving plus or the plus over here, it's just that they are giving you the two rates. The first rate, which is the lowest rate, will be the rate which is 1.7820 minus what? The 0.002. Okay, and then your highest rate, which will be this like this, will be the 1.78 plus that. If you count to the 1 month forward rate, you subtract this from this to get the minimum rate or the lowest rate, and you add this one to get the highest rate. This is how the rate, the exchange rate are going to be quoted. We have the minimum, we have the maximum too, the lowest and then the highest, and that's how you calculate it. So I will actually try to do this one, or maybe tomorrow dawn we can try this one before we move on to the investments appraiser. Any question? So
I thought you were going to solve the question.
no, sorry, I'm tired. So that is it. So we have two: investment appraiser and working capital management. So please, if there are no questions, I want to go back to my humble okay. All right. So if there are no questions, I will see you guys.
Okay, thank you.